The market is near all-time highs and a bubble may be forming in artificial intelligence, but that doesn't mean there aren't long-term opportunities in growth stocks for investors today. I'm going to go through 5 stocks that I think continue to have compounding potential. They're going to grow their businesses, whether there's a recession, whether there's a bubble that bursts. These are phenomenal businesses to own for the next 10, 20 years. Some of these are already in the asymmetric portfolio. If you want to know more about that portfolio, there's a link on the screen and a link in the show notes. That's where I'm building a market-beating portfolio from zero, and I buy stocks once a month. Keep it simple there by buying phenomenal businesses and just simply never selling them. Before we get started, I do want to thank this video's sponsor, Fiscal AI. I'm going to be using Fiscal AI throughout this video, so you'll see exactly what this platform looks like. But this is the best research tool for investors, whether you're an individual investor or whether you're an enterprise. I'm going to be showing the enterprise version today. They have data that goes back 20 years or more. And it's so easy to find everything from earnings reports and presentations to transcripts. And you can even ask artificial intelligence to summarize those transcripts for you. So not to spend an hour looking through those or listening to the entire transcript, just phenomenally useful. So if you want to check that out, 2 weeks for free, go to fiscal.ai/ASYM. If you like what you see, you'll get 15% off with that link. But let's get to the first stock that I think is a phenomenal buy. It was one of my favorite stocks coming into 2025. That is Lyft. You can see here that shares are actually up 43%. So beating the market by more than 2x so far this year. I think there's a lot of growth potential for a couple of reasons. I'll get to their operations in just a second. But look at this enterprise value to sales multiple of 1.2. Uber trading for more like 4 times sales. So that's a lot of multiple expansion that we could see from Lyft. Now, core to my thesis with Lyft and Uber for that matter is that I think these are going to be the demand aggregators for the autonomous future. The strategy here really depends on autonomy itself and the vehicles that are driving around being effectively a commodity. And I think we've seen over the past year that that's exactly how this is going to play out. There's not going to be one player like Tesla who owns this market. There's going to be dozens of companies who are making autonomous vehicles. Some are level 4, some are level 5. But 10, 15 years from now, we're still going to be interacting with applications like Lyft. That gives them a powerful position. They're going to be able to expand their market not only geographically with acquisitions like the FreeNow acquisition. That fits perfectly into that strategy in autonomy. So now this isn't just a US company. They've added Canada and they've also added a number of markets in Europe. But if we add autonomous vehicles, they're going to be able to increase supply and actually grow their business faster. So let's get to some of those numbers. Now, this is trailing 12-month revenue and net income. And I went all the way back to 2017 here. But what you can see is the business has just been compounding over the last few years. You kind of get back to a more normal business at the end of 2022, continuing to compound. You can see, let's add the growth rate in. So the growth rate now, almost 20% year over year on a trailing 12-month basis. But let's condense this chart to the past couple of years. You can see that I think the most important thing for Lyft is they've actually increased their take rate. Same thing that Uber has done. That's what has given them the ability to get to positive net income, positive free cash flow. So the business continues to move in the right direction. And the balance sheet is really phenomenal. Now, Lyft has an $8.6 billion market cap, but you can see here they've got about $1 billion in net cash on the balance sheet. I believe they actually paid off this current portion of long-term debt. So as they come out with numbers for the third quarter of 2025, we should see that come off of the balance sheet. But you're still going to have about $1 billion worth of cash. On top of that, they are generating positive free cash flow. Let's focus just on that cash flow number. You can see that nearly $1 billion worth of cash flow over the past year. There are some kind of nuances there with their insurance in particular, so may see that be a little bit volatile. But this is a positive cash flow business with a really good balance sheet, with the opportunity to grow as it expands the market with more supply in autonomous driving. Now, we're not really seeing that those autonomous vehicles actually impact the business yet, but we're seeing the supply starting to come to the market. They got a couple of interesting partnerships. One's with May Mobility. They have another one with Waymo. And then the one that could really scale the most quickly is with Mobileye and Marubeni. They're going to be bringing vehicles to market in 2026. That testing is already being done. So that's where you could see them launch in a number of cities, both in the US and in Europe. That's where we could see something like the number of rides and the gross bookings increase. That's what I have here in the blue column is the gross bookings. That's basically the dollars that are going through the system. Lyft doesn't generate all of these dollars in revenue. They're only going to generate revenue from the portion that they keep. So if they pay, let's say 80% of a ride to the driver themselves, they're only going to allocate that 20% to revenue. But bookings is what's going to give you what the actual dollars coming in are. And then This is the number of rides, 888 million rides over the past year. Those both could increase significantly as we have more autonomous vehicles, and you could see the cost per ride actually start to come down, which is actually what 10x is the size of the market. So phenomenal trends, and you're getting a really good value with Lyft. That's why this remains one of my top stocks in the asymmetric portfolio. Number 2 is Alphabet. Let's keep it simple here. Alphabet is one of the best big tech companies in the world. They are a leader in artificial intelligence, arguably making better models already today than OpenAI, and they have a distribution advantage. Not only do you have search in the surface area there, you have all of the Android devices. That operating system position is going to be extremely powerful for them. And you have YouTube. YouTube is an underestimated juggernaut in media. Add all that up, and I think Alphabet is in a phenomenal position, and you're getting it for a pretty good value despite a recent run up in shares. Now, this is a stock that I've been buying for a couple of years in the asymmetric portfolio. So I have been riding these gains over the past few months, up 50% just since earlier in the summer. So really good returns recently, but the stock's not all that expensive today, 26 times earnings, and you're getting a compound annual growth rate even over the past 3 years. Remember, this is after all the ChatGPT moment. Search is supposed to be disrupted, but they've grown 10.1% over the past 3 years. And let's look at those trends. First of all, let's look at what long-term compounding looks like. I mentioned earlier, this data goes back 20 years, so you can see that the compound annual growth rate, 23% over the course of 20 years. If you can find companies that are going to compound revenue over 20% over 20 years, those are guaranteed to be winners for investors. So that's how you get to the level of growth that we see here. That growth rate has slowed to 13%, but I'll get to some of those details in just a second. And you can see that net income has grown tremendously as well. So let's focus in on the last couple of years. And I went back to September 22. The reason for that is ChatGPT came out in the fourth quarter of 2022. So you can see that revenue growth actually declined a little bit to 4.1% in 2023. This is when the market was down, so spending was down a little bit for advertisers. But you can see that growth rate has actually increased to about 13% since ChatGPT came out. So we're not seeing the disruption that I think is the common narrative in the market. And now that the market is starting to realize that maybe Google and Alphabet is not going to be disrupted all that much, maybe it deserves a little bit better multiple than it's currently getting in the market. Let's also look at some of their operating segments. This is the revenue coming from each of these segments. In blue, you have Google Search, so that continues to grow. The YouTube business, now over $50 billion in revenue. If you add in their subscriptions, that subscription business actually falls under Google Subscriptions Platform and Devices. That's in green, so you can see that also growing at nearly a 20% compound annual growth rate since the March 2023 quarter. The one business that's in decline is the networking business. And this is the ads that you see all over the internet. Publishers can put an advertisement from Google on their website. That's obviously in slow decline, but it is still a pretty significant cash flow business for Alphabet. And then there's other bets, $1.6 billion in revenue. This is where Waymo falls, another business that has a lot of value, but isn't generating a lot of revenue or any cash flow or profitability at this point. But you look at that Waymo business, that may already be worth several $100 billion, and it's just hiding on Alphabet's balance sheet. Another thing we need to think about is how much they're investing in data centers and artificial intelligence. I think the plan for this year is about $85 billion in CapEx over the trailing 12 months. Through the first half of the year, they're at about $67 billion in capital expenditures, but you can fund that through their cash from operations, $134 billion in cash from operations and rising. They can bludgeon the competition with cash. I think that is really the advantage that they have. So they have a distribution advantage, they have a talent advantage, and they have a balance sheet and cash flow advantage over the competition in artificial intelligence. Nobody can match that in AI today. And where you're going to see that on the income statement is in the Google Cloud revenue and operating income. Google Cloud revenue over the past couple of years, nearly a 30% growth rate, actually higher than 30% growth rate in the most recent quarter. And look at this improvement in operating income. Didn't even become operating income positive until the September 2023 quarter, at least on a trailing 12-month basis. That is now a pretty solid margin business. And I think these margins could actually double to improve that profitability. So everything is moving in the right direction for Alphabet. This is not going to be a 40, 50% revenue growth company like maybe OpenAI is, but it is going to be a company that I think is still going to be very, very valuable 10, 20 years from now. If they can compound their revenue, even at 12, 13, 14%, we're paying a pretty good multiple for the stock. revenue growth, margin expansion, multiple expansion, you add those things together. That's how you get a market beating stock and an asymmetric return potential for Alphabet stock. So that's why it's number 2 on my growth stocks to buy today. Number 3 is one I recently added to the asymmetric portfolio. That is Duolingo. Duolingo is a leader, obviously, in teaching language, but I think what's misunderstood here is they're not really being disrupted by artificial intelligence. AI is actually a benefit for them. They're actually the largest user of tokens from the OpenAI API. And the reason that they are is their max subscription allows you to have a conversation with an AI in another language. So very token intensive, but also very, very valuable. And this is not a company that's all that pricey. $15 billion market cap. The price to earnings multiple looks high at 130, but we'll look at their margin and the margin improvement in just a second. The 15 price to sales multiple, enterprise value to sales multiple, looks really high. But again, when you put that in context with the revenue growth, I don't think that's an unreasonable price to be paying for the stock. So here we have revenue in yellow, the growth rate, revenue growth rate in the blue, and net income in orange. I'll turn this to trailing 12-month numbers here to maybe make the picture a little bit clearer. So what you're seeing is a growth rate that's nearly 40% right now. There's been some ups and downs over the past few quarters as they kind of adjust their pricing and how they're going to market. But I think this could actually accelerate to a higher than 40% growth rate. But that's a phenomenal growth rate. And you can see that the margin improvement has really been phenomenal over the past few years. This is as they're expanding more into more modalities in their business. So the opportunity for Duolingo is not adding more languages. They've got almost every language that's really going to be a significant market. It's the way that they think about their business and their ability to move into more modalities. So the foundation for Duolingo is built on the idea of being able to learn a language so you can be proficient enough to have a job. That's a pretty simple goal. But now move that into things like math. They've added chess. And where I've seen the value here is actually in their kids program. They're not actually charging for any of those products for kids, but that's how you get lifelong learners on the Duolingo platform. So as they add more things, there's a lot they can add in math, they can add in science. Think about all they could do with computer programming. There's a lot of opportunities to grow the Duolingo platform. I think they're only scratching the surface there. So over the next 10, 20 years, this is the kind of company, and their CEO is still the founder of the company. So they have that founder mentality. They have a clear vision. I think this is going to be one of the best stocks over the next 10 or 20 years. That's why I recently added it to the asymmetric portfolio. It isn't the cheapest at a 15 price to sales multiple, but given the momentum in Duolingo, given the fact that they are expanding their user base, and they still have a tremendous opportunity to move people up the paid curve. In yellow, what you have is the monthly active users. Blue is the daily active users. So nearly 50 million daily active users and less than 11 million who actually pay for the product. So less than 10% of monthly active users actually pay for something on Duolingo. I think there's a tremendous opportunity to move that up to 15, 20%, could actually increase their prices and add more value by adding more of those modalities. This is how aggregators work. It's a playbook that we've seen be successful for investors over and over again. So Duolingo, stock that you should consider at least putting on your watch list if you don't have it there already. The Trade Desk is number 4. The Trade Desk, $26 billion market cap. This has become extremely unloved by investors. Look at this. Over the past 5 years, the stock has essentially gone nowhere, but the business has. You can see here that since 2014, the compound annual growth rate, 48%. It's actually condensed that down to just the last 5 years. So since 2020, 30% compound annual growth rate. And this is still a highly profitable business. This is a two-sided market for advertisers. So it's really aggregating supply for the Trade Desk. Now, there's been a bunch of challenges with some of their new products. They backtracked on some of that recently. I think those moves and actually listening to customers are going to ultimately pay off. And the growth opportunity, especially for things like digital media, digital television, is going to be absolutely tremendous. They have all the right partnerships with companies like Disney and Spotify. And when you look at things like their gross billings and the number of clients that they're working with, these continue to move up and to the right. I think this current moment is going to be a blip for the Trade Desk. This is a founder-run company. It's a compounder long-term, and it's in a market that continues to expand. So I think shares will recover over the next few years. We're getting a pretty good price, although it's not the cheapest stock, 64 times earnings. Although look at this forward price to earnings multiple is 28. So obviously analysts think that profitability is going to improve over the next few quarters. And the price to sales multiple is just 9.3. That's pretty solid for a company that's growing at a 32% growth rate over the past 5 years. So the trade desk don't overlook the opportunity there. The final stock for today is one that continues to put up phenomenal results, but continues to be beaten down by the market because there's so much uncertainty about consumer spending and about tariffs. But listen to what management has actually said. On Holding is serving the high end of the market. This is people who can afford a $200, $300 pair of shoes. They are not in a recession right now. The people who are currently in a recession, struggling to find jobs, are people who are looking for much lower priced shoes. So that economic pressure should not be something that holds On's growth back. The other thing is margins could come under pressure if tariffs are a big impact. But management has said basically, look, if tariffs are going to increase our prices in the US, we're going to simply raise our prices. And they have shown that they are doing that over and over again. So listen to what management is saying. Listen to their history and their ability to beat their own guidance and actually pick up their growth rate. This is not an expensive stock. It's a nearly $14 billion market cap. But you can see the forward price to earnings multiple is 30. That's despite the fact that it's very difficult to be profitable as a consumer goods company when you're making something in the physical world. There's a lot of spending that has to happen ahead of that growth. So the fact that they're profitable at all when they're growing their growth rate at 43% over the past 3 years is incredibly impressive. And the enterprise value to sales multiple is just 3.9. For context, Nike, which has negative revenue growth over the past 3 years, has an enterprise value to sales multiple of 2.2. But one of the things that does confuse investors with On is they report their earnings in Swiss francs. So what I've done here is in Fiscal AI, you can change from Swiss francs to US dollars. And so I'm showing these in US dollars. And you can see that their growth rate in the most recent quarter, nearly 36%. You can see that their margins have improved. The challenge when analyzing a company like this is when you have sales in US dollars, you have cash in US dollars, you can typically have lower sales and lower margins when looking through the lens of the Swiss franc. And one of the things that they often have in the quarters where the US dollar is weak is they have to actually report a loss on the cash that's sitting on the balance sheet, the dollars that are sitting on the balance sheet. So it looks like they're not profitable, when in fact, they are actually profitable. And especially as a US investor, the fact that they're holding US dollars should be a good thing long-term. I think what On should eventually do is just report in US dollars. It makes things simpler for investors, and most of your investors are going to be in the US. But look, operations are going extremely well. You can see that the revenue growth rate is actually picking up over the past couple of quarters. So we're not seeing that consumer pressure that you may be seeing with other brands. Their margins have been phenomenal. They have the ability to expand not only into more areas in shoes, but also into apparel. I recently bought some apparel from them, just phenomenal quality, very high price, but that's exactly what you get with On Holding. So I think the value here, the growth, and the fact that this is a brand that people are leaning into more and more makes this one of the top stocks over the next 5 to 10 years, continues to be one of my top holdings. Like I said, if you want to see everything that I own in the Asymmetric portfolio, check out Asymmetric Investing, my newsletter. You can get all my research there, and premium members get access to the portfolio and every stock that I buy every single month. So check that out. And don't forget to look at Fiscal AI. Like I said, you can try that for 2 weeks for free at fiscal.ai/ASYM. Let me know what you think about these 5 stocks and what I should add to my list next month. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.